Welcome back to the Deep Dive. Today, we are putting on our financial detective hats.
Yeah.
Because we are diving deep into the world of non-physical assets. Forget the factories, the equipment, all that tangible stuff.
Right.
We are looking for the patents, the software, the brand names, the hidden engines that really drive modern business value.
That's right.
We are deep diving into intangible assets.
And this is the stuff that, well, it gives companies their competitive edge, right? It's the value you can't physically touch, but it makes all the difference between just a company and a market leader.
Exactly.
Our mission today is pretty critical. We're going to unpack the accounting rules, specifically IAS 38 and IFRS 3, that draw a really sharp and sometimes honestly counterintuitive line between what a company must treat as an instant expense.
Gone, just vanished.
Yeah, versus what it gets to capitalize as long-term, verifiable asset value on its balance sheet.
And this is, well, it's the ultimate financial shortcut for you, our listener, because if you understand these rules, you instantly get a sense of what value the company legally can claim on paper.
Right.
Versus the potentially massive value it's actually forced by the rules to ignore. We're sort of peeling back the conservatism that's baked into these standards.
It really is the difference between, say, reputation and actual recognition on the books. And it's kind of a philosophical conflict right at the heart of accounting.
Okay, let's start with the basics then. What exactly defines this invisible gold? What is an intangible asset?
Well, the standard, IAS 38, it defines it pretty clearly as an identifiable non-monetary asset without physical substance.
Okay.
So it has to meet the normal definition of an asset first, meaning the company controls it, often through legal means, and it expects future economic benefits from it, money coming in down the line.
So we're talking about things like software licenses, maybe,
Yeah.
copyrights, customer relationships, trademarks, stuff like that.
Exactly. But just being non-physical isn't quite enough to actually make it onto the balance sheet. It has to pass this really crucial filter, the identifiability tests.
Okay. Identifiability.
Exactly. So for an asset to qualify under these standards, it must meet that basic asset definition and one of two identifiability criteria. The first one is it separable?
Separable, meaning?
Meaning, can the asset be sold, licensed, rented, or exchanged either by itself or maybe along with related contracts?
Okay, so if a tech company can sell off a single patent to someone else without selling the whole business, that patent is separable.
Precisely. That ticks the box. The second criterion is that the asset arises from legal or contractual rights. Think of things like specific government quotas or maybe operating licenses, long-term favorable service contracts you might acquire. These rights, even if you couldn't sell them separately easily, they often come up as part of buying an entire company. But if the item fails both criteria-like, you can't really separate it out, and it's not based on a specific contract or law, then it just doesn't make the cut as an identifiable intangible asset under IAS 38.
That makes the barrier pretty high then. Okay, so once we've identified it, the next logical question is, how do we actually count this value? How do we measure and recognize these intangibles?
Okay, first, the general recognition criteria have to be met. It must be probable that future economic benefits will flow to the company.
Okay, likely to make money.
And critically, the cost must be measurable reliably. If you clear those checks, then the initial measurement for a purchased intangible asset, say a patent you just bought or a license fee you just paid, is usually straightforward. It's recognized at its verified cost.
Yeah, that makes sense. Simple enough. I bought it for $5 million. It goes on the balance sheet for $5 million. But what happens after that initial purchase?
Yeah.
When we look at subsequent measurement, I've heard there are like two options, but one is almost never used.
That's the interesting part. Most companies overwhelmingly use the cost model. This just means the asset stays on the books at its original cost, minus any accumulated amortization and any impairment losses over time.
Okay, standard depreciation, but for intangibles.
Sort of, yeah. Amortization. The alternative is the revaluation model, where the asset could potentially be revalued to its current fair value.
Revaluation, that sounds way more exciting. I mean, if my brand value doubles, I'd want to show that to the world. Why isn't everyone doing this?
Well, because the revaluation model is only permitted if an active market exists for that specific identical type of asset. And IAS 38 is very, very clear on this point. Active markets for intangible assets are extremely rare.
What does that mean in practical terms? An active market, that means like identical items traded all the time with public prices, right? Like stocks or commodities.
Exactly. Think of, certain types of government bonds or maybe barrels of oil. But for the vast majority of valuable intangibles, your unique software code, a specific drug patent, or, say, the Coca-Cola brand name.
Right. Unique things.
They are inherently unique. There's no stock exchange trading unique soda logos where you can get a reliable daily price. So because there's no reliable public market price to benchmark against,
You can't use the revaluation model.
you can't use it. The very uniqueness that makes them so valuable is precisely what prevents them from being revalued upwards on the balance sheet under the rules.
Wow, that's a really powerful insight. So basically, if I see an intangible asset on a company's balance sheet, I should pretty much assume they're using the cost model because the standards almost force them into it.
That's generally the safest assumption, yes.
Okay. And what about their useful life? How long does this recorded value stick around?
Good question. If the asset has a finite useful life, like, say, a patent that lasts for 10 years, it must be amortized over that life. That expense flows through the profit or loss statement each year.
Spreading the cost.
Right. But if the company determines the asset has an indefinite useful life, maybe a strong brand name acquired in a purchase that they expect to support indefinitely, then it is not amortized.
No annual expense.
No annual amortization expense, but there's a catch. It must be rigorously tested for impairment at least once a year, and more often if there are signs its value might have dropped.
Okay, so indefinite doesn't mean immortal. It just means no predictable end date yet.
Exactly. It needs constant checking.
Got it. Now, this brings us to, I think, where the most significant kind of financial distortion happens, or maybe value that's intentionally ignored by the rules. Let's move to that critical distinction, the internal versus external divide, especially looking at brands and goodwill.
Yes, this is really the core paradox of modern accounting for intangibles, and it directly answers your earlier point about the shortcut. Generally speaking, if a company generates an intangible asset internally through its own efforts.
Like building a brand.
Exactly. The associated costs, marketing salaries, advertising campaigns, R&D spillover, they are incredibly hard to identify separately from just the general costs of running the business. And because of that lack of reliable measurement, the standards enforce extreme conservatism.
It almost seems perverse, though. Why does accounting punish internal success? I mean, say I spend billions building the Apple brand over decades. That's arguably the most valuable thing the company owns. But I have to expense all that marketing spending instantly, as if it just evaporated the next day.
You've hit the nail right on the head. Because those costs are so mixed up with day-to-day operations, salaries, marketing, rent, general overhead, they fail that critical, reliable measurement test for creating a distinct asset. And this leads to a specific list of valuable things that are never recognized as assets if they are internally generated. This includes inherent goodwill, brands, mastheads, publishing titles, customer lists.
Wow. So if a company is boasting about its world-class brand equity that it built itself, you know for a fact that billion-dollar value they're talking about is intentionally completely excluded from the balance sheet numbers.
That's the rule. Now contrast that. What if that company buys the Coca-Cola brand name from, let's imagine, a hypothetical previous owner for $50 billion? Then, because the brand was acquired separately in a transaction...
There's a price tag.
Exactly. There's a verifiable purchase price. That $50 billion cost provides the reliable measure that the standard demands. So yes, in that case, the acquired brand can be recognized as an intangible asset on the balance sheet and capitalized at that $50 billion cost.
That distinction is just monumental.
Yeah.
You can capitalize the cost of buying a brand, but not the potentially billions of dollars of marketing, innovation, and sheer effort you spent successfully creating your own.
It's a deliberate conservatism, and yes, it creates this massive measurable gap between the perceived market value of a company and its reported book value.
Wow.
And we see basically the same principle at play with goodwill. Goodwill is usually covered under IFRS 3, the standard for business combinations, when a purchase happens.
Right.
Goodwill is essentially the premium you pay when you buy another business. It's the difference between the total price you paid for the company and the fair value of all its identifiable, separable net assets. It's factories, patents, cash, minus its debts. It represents all those other valuable, intangible benefits, like a great reputation, maybe some unique technical know-how in the acquired team, good management practices, things you couldn't put a finger on separately.
So if I buy a small software firm for, say, $5 million, and after valuing all their patents, computers, cash, and assuming their debts, Their identifiable net assets are only worth $3 million in total.
Yep.
That extra $2 million I paid is goodwill.
Correct. That is purchased goodwill. It arises specifically from an acquisition transaction. That $2 million gets recognized on your balance sheet, it's capitalized, and like indefinite life intangibles, it's not amortized, but tested annually for impairment. You're essentially capitalizing the acquired management team's presumed ability to generate future excess earnings.
But again, what about the fantastic reputation and the incredibly effective management that my own company built over 20 years without acquiring anyone?
That is inherent goodwill or internally generated goodwill. It has no objectively identifiable, separable cost basis from a transaction. So it fails the recognition criteria. It is entirely invisible on the balance sheet. Accounting standards fundamentally prioritize the verifiable transaction price of an acquisition over potentially decades of proven but internally generated excellence.
That's the trapdoor right there. Okay, let's shift gears slightly to where companies spend enormous amounts of capital specifically hoping to generate future intangible value. Research and development, or R&D. This is where it gets really interesting, isn't it? How does a company legally separate, exploratory failure from potentially reportable future success?
Yes, this is the capitalization tightrope walk. IAS 38 forces companies to segment their spending very carefully into two distinct phases. First, there's research.
Okay.
Research is defined as the early stage, original, and planned investigation undertaken to gain new scientific or technical knowledge and understanding. Think lab coats and test tubes, initial explorations.
And the development is different.
Yes. Development is the application of those research findings or other knowledge to a plan or design for producing new or substantially improved materials, devices, products, processes, systems, or services before you actually start commercial production or use. It's taking the idea towards reality.
Got it. Research is finding knowledge, development is applying it. How's the accounting treatment differ?
It's stark and pretty unforgiving for the research phase. All research costs, the exploratory work, the initial failures, the scientific dead ends, they must always be written off as an expense to the profit or loss statement as they are incurred.
Instantly gone. You don't get to capitalize curiosity or early stumbles.
Nope. You expense them immediately. But development expenditure, that phase where you're actively building towards a commercially viable product or process, can potentially be capitalized as an intangible asset.
Can be. There's a catch, I assume.
Oh yes, a big one. It requires passing a demanding 6-point test. These criteria collectively aim to prove both the technical and the commercial feasibility of the project. It's extremely rigorous.
6 criteria. Okay, let's break them down. What does a company have to show?
Right. To capitalize any development costs, a company must demonstrate all 6 of these. Let's use a biotech firm developing a new drug as an example. First, they have to show that probable future economic benefits will flow to the company from this drug.
Okay, it's likely to make money eventually.
Second, they must have the clear intention to complete the asset, the drug development, and then actually use it or sell it. No half-hearted projects.
Makes sense. Intent.
Third, they need a reliable measure of the development cost incurred. This means having good cost tracking systems in place.
Right. Got to track the spend accurately. That's 3. What else?
Fourth, and this is a big one, they must have adequate technical, financial, and other resources available to actually complete the development and then use or sell the asset.
So even if the science is great, if they don't have the money or people to finish it?
They fail this criteria. Exactly. Fifth, the technical feasibility of completing the intangible asset so that it will be available for use or sale must be demonstrable. The science has to actually work, like showing positive results in clinical trials.
Proof it works. Okay.
And finally, sixth, they must demonstrate how the asset will generate probable future economic benefits, essentially, showing that the project is expected to be profitable. The benefits from sales need to clearly exceed the costs of development and production.
Wow, that is a staggering hurdle. So let's take that biotech example. If they have amazing phase 2 trial results, proving technical feasibility, criterion 5, but their CFO then says, look, we just don't have the $100 million needed for the large-scale phase 3 trials. They fail criterion 4, adequate resources.
Correct.
And what happens then? All the development money spent so far.
It must be expensed immediately in the period they fail the criterion. If even just one of those 6 criteria fails at any point during development or isn't met yet, the costs incurred up to that point or during that period are expensed.
Instantly written off.
Instantly. The standards demand comprehensive proof that the project is not just technically possible, but also commercially sensible and financially viable before any capitalization can begin or continue.
And there's a crucial rule here too, isn't there? Something about not going back.
Yes, absolutely critical. If a cost was initially classified and expensed during the research phase, it's gone forever from an asset perspective, even if that project later becomes wildly successful.
Beyond wildest dreams.
You cannot go back and capitalize those earlier research costs that were already expensed. Once an expense hits the income statement, it cannot be resurrected later and turned into an asset on the balance sheet.
It really forces that conservatism and verifiable proof at each stage.
That's the guiding principle.
Okay, so this brings us towards wrapping up. What does this whole complex discussion really mean for the person reading the financial statements? For you, the listener, trying to understand a company's value?
Well, I think what it boils down to is this. The accounting standards demand a high degree of certainty and verifiability. So the only intangible assets you typically see sitting on a balance sheet, outside of goodwill arising from an acquisition, are generally one of two things.
Okay.
Either they are separately purchased assets, like a license or a patent that came with a clear, verifiable price tag, or
Yeah.
or they represent that relatively small slice of internal R&D development costs that managed to survive that brutal 6-point feasibility gauntlet we just discussed.
Right. So the insight here is really the inverse, isn't it? It's about what's not there. The things that we often think of as the most critical value drivers of a successful established company, its hard-won reputation, its internally grown brand equity, the inherent skills and culture of its workforce.
All that secret sauce.
Yeah. All that stuff is intentionally excluded from the balance sheet asset figures. That value has effectively been written off over the years as just a necessary operating expense incurred to run the business.
Exactly. So you could say the balance sheet tells you the absolute baseline minimum of verifiable, long-term, non-physical value that the accounting rules permit recognizing. It says very little potentially about the true market-driving equity built up over time.
Which leaves us with our provocative closing thought for you to chew on. Considering that standards like IAS 38 require inherent goodwill, internally generated brands, proprietary customer lists, often the very things that guarantee future profit and competitive advantage, to be instantly expensed and never recognized as assets, just how much? What percentage of a truly successful company's actual long-term economic value is deliberately invisible to the external investor who relies only on the reported numbers in the financial statements?
That's the gap you always need to consider in your analysis, a potentially huge one.
Something to think about. Until next time, keep digging into those invisible numbers.